with Klarna, and he joins me now from Sweden, from Stockholm, Sweden. Great to have you, Sebastian.
Thank you for having me.
So you've mentioned that credit defaults were low. Great news, encouraging news. Are you concerned about that changing at all?
Well, not entirely, actually, because if you look at it, I mean, what's very different about the credit model that we do, right, is it's extremely short durations and very low average balances, right? So your average credit card balance might be about $6,000. Klarna's average balance is about $100, right? So it makes a very big difference. And the whole problem with credit cards really is that they're built up to make you borrow as much as money, right, as possible. So that's why they gather all of your transactions on a monthly basis and then say, please, please, please pay less than your full balance so that you start revolving and build up a balance. And they want you to max to make as much revenue as possible. We only offer installments. They're short term. They get paid down within 8 weeks. It's fixed terms and it's small amounts, right? So those are important factors to keep in consideration when you move into a worsening economical environment like we are.
Can you explain then who your demographic is, who your clients are? Because when you think about more traditional banking providers, Citibank, for example, saying this week that it is actually seeing softening in terms of consumer debt, saying that people are taking longer to pay back debt. People are sometimes unable to pay back debt. Is this just a totally different clientele?
Well, partially it is. I think that the important factor here is that if you look at it, first and foremost, like in the markets that we're very mature in some of the European markets, it's the 80% of the population that uses us. It's basically everyone. But what really sets our customers aside is that they're super tired of credit cards. They're super tired of products that are rigged against them to try to make them borrow as much as possible. And instead, they want to go back to what some people still remember used to be the way cards used to work. Every time you made a purchase, you pressed 1 for debit or 2 for credit. So you had that optionality. And this is exactly what we encourage people to do. Don't use credit for every purchase. Use debit occasionally, credit occasionally. So I think what we're seeing, however, in the US right now, in the numbers you're quoting, is also somewhat of an apple to bananas comparison. Because what COVID meant was that a lot of people got a check, people spent much less money, and credit card debt, as you may remember, was dramatically down as a consequence of the almost enforced savings programs that most of our consumers were at during the COVID times. So what we're seeing now is slightly a reversal of that. And in general, then I think banks maybe have been a little bit too open and too desperate to get more credit card balances back up. And maybe we're too relaxed in the underwriting policies a year ago.
Well, Sebastian, I think that's an interesting point. I think it would be helpful for you to explain to us how Klarna makes money, right? Because part of the incentive for banks to encourage us consumers to rack up debt is that the more debt we accumulate, the more interest that the banks make. So help us understand how Klarna makes money.
Sure. So, I mean, the difference is in 2 ways, right? But the most important one is that by offering people a healthier form of credit, one that doesn't charge them, 30% interest rate, one that doesn't encourage them to borrow more, with a short-term installments and a zero interest, consumers have availability, and this drives merchants' ability. Merchants see that they simply have more sales. More people are making those purchases, and that drives up temps. So merchants are simply interesting in providing these payments products because they see better conversion rate, because they see better results. And so we're more than your typical financial institution. We have a higher proportion of our income coming from the merchant side and the kind of acquiring side of the product. We are our own network. So we're basically competing with Visa, MasterCard, and American Express in the sense that we are a full payments network with both debit and credit, but we have direct access to our merchant base, which also gives us a healthier, there's less middlemen in our model, which also makes it possible for us to earn more per transaction.
Interesting. Well, Sebastian, there's so much more we could talk about, but unfortunately we've run out of time. Great to have you on the program today. Thank you.
Thank you for having me.